Hello, everyone. Welcome to the Monday Morning Podcast. Today, I talk to Brian Chu. We discuss things related to gold, cryptocurrency, and some very big macroeconomic moves afoot. If you're interested in either of these two things, it's a fascinating watch or listen, and there's some great nuggets in there for investors. I really want to talk to you today about gold and also some big developments in the monetary system. There's been a lot of talk about gold's safe haven status being eaten by Bitcoin. What are your thoughts on that, and can the two coexist?
That's a really good question because I have kept an eye on the cryptocurrency developments, and Bitcoin has actually really gone off, like just gone off on a almost what you could call a rocket ride, and it's tumbled quite a bit in the last 3 weeks. Probably I think down about 45%, almost 50% now. Now, safe haven status, one would say if something is so volatile, it's not really a safe haven. But the argument behind why cryptocurrencies have been going up is because of the belief that it is secure and there is a way to maintain anonymity if you are holding cryptocurrencies. So it's harder for you to have your transactions being tracked. But I think recently, this is starting to unravel a little bit. If you're aware of the colonial pipeline hacking, I think it was about 2-3 weeks ago, a ransom was paid by the Department of Justice to the hackers called the Dark Side. And I think there was news coming recently that the part of that ransom has actually been recovered by the FBI. So there may be anonymity, but there is actually some strings attached to cryptocurrency. As for gold, it is possible for people to actually track where gold is because bars of gold also have serial numbers. And if you steal from us, if you steal these bars of gold, you'll probably find it a bit hard to go and sell it somewhere else if people are notified that these are stolen. So as for whether they both coexist, I have written some articles about cryptocurrency and gold actually working hand in hand, in the sense that when we move, and I notice the word I say when rather than if, when we move out of the current fiat currency system and move into a digital currency system, I believe that there has to be an adjudicator in there, and I believe that precious metals and perhaps a basket of commodities would be the way to go in determining what is a fair price for the digital currency. So for those people who are still embroiled in the war between gold and cryptocurrencies, I'd say hold your fire because you're firing at the wrong people.
I think that's completely fair, Brian. But there are also some big developments coming out from central banks and governments around the world regarding central bank-backed digital currencies, or CBDCs. I noted a recent report that some 80% of central banks around the world are developing or looking at central bank-backed digital currencies. I was wondering, what are your thoughts on how their launch could play into the gold price?
Well, I think the whole idea that the central banks are going to move from fiat currency to a digital currency is one that rings alarm bells among a lot of people who are into liberty and into freedom. And as we have seen with the massive political upheaval in the last 5 years, starting with, I'd say you could say Brexit was the first shot heard around the world that those in authority are losing the narrative. So them bringing in the central bank digital currency and the people having seen that they're trying to maintain control, you're going to have a pretty divided world. As for where gold could probably go, I believe that people will seek flight to safety in gold and cryptocurrencies, and hopefully try to cause a central bank digital currency to not be able to get off the ground because there's very, very strong competition, as well as the potential for central banks to be exposed for the fact that they were the ones behind causing massive inflation and deflation cycles in the last 108 years since the Federal Reserve was set up.
Well, that was certainly the justification that that was used when El Salvador launched Bitcoin as a legal tender, or at least announced that that was the move, was that central banks had basically destroyed the value of their own currency. So I guess my next question is more macroeconomic, and that's I've seen some commentary in the AFR that gold is going to be used as a hedge against disinflation or deflation more so than inflation. Do you think there's something to that? And where do you stand on the deflation inflation debate, both in the US and in Australia?
It's interesting that people talk a lot about inflation and deflation, except they use different definitions for it. We currently consider inflation as being a period where the consumer price index goes up. In other words, it costs more to buy goods and services relative to the past. But I'll use the most watertight definition of inflation and deflation, which is the relative change in the relative increase of currency to productivity. So inflation would occur when you are creating more currency than the economy creates goods, services, and assets. So you got more currency swimming around, trying to trying to find a place to be in. And if the economy is inflating, it's simply because they're not producing enough to cover for the additional currency being created. Deflation is the other way around, whereby either currency is disappearing from the system, or the economy is much more productive than they are creating currency. Somehow, living in a debt-driven economy, we are taught to actually hate deflation, when in reality, if your economy is very productive, then deflation is fine. Think about your computers, think about your mobile phones. Prices have been going down on computers and mobile phones. Is that a failing sector? Not at all. In fact, we're getting new technology every couple of months. Most of us are probably changing our phones every year, 2 years. In some cases, some people change it every couple of months. Whereas with other industries where there's slow development, the reason is because there's not much activity involved. Now, in terms of what's happening with gold, the correct argument about gold being a hedge against inflation or deflation could be said as gold doesn't change. A bar of gold is a bar of gold, the past, present, and the future. So how much a bar of gold buys, that is actually where you could say there's inflation or deflation. There is a very famous statement about what gold buys over time. And back in the days of Rome, a bar of, you could say, I think an ounce of gold would buy a man his toga, which is like their business suit. This didn't really change up to the 1930s when a bar of gold, when an ounce of gold, you could say, would buy a man his business suit and enough for dinner for his family. And today, an ounce of gold in Australian dollar terms is about $2,450. You can buy a couple of business suits in not so good quality. Like you can buy from a department store, but we're not talking about the tailor-made suits that people used to wear back in the 1930s, and that still would probably set you back about $2,450. So if you have an economy where deflation occurs, either because we're more productive or because currency is disappearing because there's a credit's drying up, there's a freeze in the market, the bar of gold is probably going to buy you as many goods as you normally would expect, maybe a little bit more for certain types of goods and maybe a little less for other goods. But I'll say the basket of goods and services that you normally consume, I think even if the price comes down, the bar of gold, you're pretty much going to be secure being able to buy what you need to maintain your living standards. So that's why I think the Australian Financial Review, for all that's worth, they're actually on the right track in saying gold is able to hedge against both inflation and deflation. It's the relative amount of what the bar of gold buys, rather than simply just watching prices go up and down according to what the economists say behind their closed doors.
Well, I've got a few thoughts on that, Brian. First of all, the CPI has always been a major bugbear for me. I've never really put much stock in the way they calculate it. Second of all, I really like that idea of the suit and a nice meal sort of index or metric. It reminds me a bit of the sort of Big Mac index or something like that. So that's actually really interesting for me. And I want to get to another question here, and that is, what are you seeing in the gold market at the moment? Is there a big gap between the physical market and the paper market? And could you just explain a bit about what that is for those who don't know?
Yeah. So there is a difference between the physical precious metals market and the market according to the commodities index. So the commodities index is where digital contracts are exchanged between either the investment banks that are running the metals trading desk in order to generate profits, as well as providing services to manage the risk of their investors. You also have some commodity producers using the commodities exchange as a way to fix prices when they're selling their production into the market. They also need to do that when they're borrowing from banks in order to build their mines and maintain their operations. Part of the loan that the banks offer to these companies are based on a hedging arrangement where they have to sell a fixed amount of their future production at a pre-agreed price to the investment banks as a way to, you could almost say it's a collateral. Yeah. Now, that's the digital contract market. That drives much of the price movements we see on the ground, whether it's the price you pay in a jewelry store or when you go to a bullion store to buy coins. They will quote the price according to what is determined by the exchange. However, the digital contracts, you actually have a lot of traders who will use the market to manipulate the prices by dumping massive amounts of contracts in order to get the price they want. This affects the price levels that you would see on the ground. Now, with bullion stores, when you buy a coin or a bar, you don't actually pay the spot price, simply because the bullion store has to actually make a living. They've got to keep the lights on. They've got to pay the salary to their staff. So you pay a premium. My understanding is the premium for gold and silver coins and bars have gone up significantly, more so in America, I heard. I got a friend of mine who lives in Iowa, and he's saying that the US Silver Eagle is currently trading at about 50% above spot. I think same time last year, it was about 30%. As for Australia, if you go and buy a 1 ounce Perth Mint gold coin, you're expected to pay 4% above spot. Hasn't really moved much over the last 6 years I followed it. Whereas for silver, I think 1 ounce Perth Mint silver coin is about 30 to 35% above spot. And I think about same time last year was about 25%. So there is a significant difference, even though if you have looked at the price of gold in the last 3 months, we saw a recent low at about 2,200 for an ounce of gold in the beginning of March, and now it's 2440, 2450. It's gone up by 10%. What I'm seeing is there has been a massive demand for physical gold and silver, while the digital contracts haven't moved by as much. But if you go to a bullion store, you will notice shortages in stock as well as a higher premium in some cases.
That's a fascinating breakdown, and I guess the main thing that I drew from that was that you really have to be clever when you are going to buy physical gold, because there is a margin on that, and you do need to know what you're actually purchasing. So that leads to my last question for you, Brian, which is, what's your outlook for gold stocks in the short term, and what advice would you have for people who are interested in investing in gold?
Okay, so I run a personal gold fund myself using my own assets, and we are currently pretty much fully invested in gold mining stocks and have a very little cash at the moment. Reason being, I personally expect that after the 18th of June, which is the third Friday of the month, every quarter, March, June, September, and December, the third Friday is what we call quadruple witching day. That's when a lot of the derivative contracts expire. And before the close of the market, you'll see massive movements as fund managers, traders try to close off their positions. After this quadruple witching day, I expect the price of gold to probably dip quite a bit. We're currently at 1895 US dollars and 24,450. It is possible. I wouldn't be surprised if the price of gold dips back to about 1800 US dollars. If it does, that's like pushing a beach ball into the air, and it's going to bounce up pretty hard. We have the Northern Hemisphere summer coming, and traders are going to be going on holidays in July and August. This is where you'll expect the price of gold and silver to really head up. And mining stocks are going to be rallying pretty hard. Have a look at the historical patterns in the last 8 or 9 years. You would see that the ASX Gold Index, the HUI Index, and the GDX in America, which tracks gold producers, they tend to go up by a lot during this period. I think it is a good time to have a look at some good producers on the ASX. If you're currently a subscriber to Rock Stock Insider and Hard Money Trader, I have provided quite a number of recommendations for you, so you can check them out. The Rock monthly report came out yesterday, and I provided my subscribers not just with one tip, but there are 3, because we also are in a promo campaign, and the new subscribers and existing subscribers got an update of the report, 5 gold investments to make now. So you've got 3 stock recommendations to play with. Those are Hard Money Trader. You've received a couple of new stock recommendations on gold and silver explorers. Some of them are doing pretty well already. And I expect the existing recommendations, I'm trimming down quite a few of them, being very brutal about it. If it hasn't moved in the last 3 months, it's gone. What I mean by it's gone, it's out. I'm cutting it out of the list. We want to have a very lean and mean portfolio for the hard money trader investors, because when the gold price really moves, I think these stocks are really going to head up, and you'll probably be able to brag with your friends and parties who've been talking up about how well they've done with Bitcoin. So when they're talking about their Bitcoin and their Ethereum, you could probably talk about a couple of the stock recommendations. Maybe not now, not too much to brag about yet, but maybe around late July and August, you have a few up your on the belt, and then I look forward to seeing people do well, because I'm invested in a couple of them myself. So we're all in this together.
Awesome, Brian. I'm going to be doing a bit of sort of portfolio trimming, trying to make it mean and lean going forward myself. So I thought that was really interesting. Your point about seasonality in the gold price and gold stocks, and I don't think a lot of people talk about that. So I thought that was great, and I really appreciate you spending some time with me today, Brian. Um, I'm I'm just going to stick it out with this lockdown and get on to business as usual.
Yep. One more thing I'm going to plug as well is this week's Daily Reckoning. I will be talking about the Australian CPI and how some of the data is manipulated. In fact, your electricity bills, especially now that we're going into winter, some of you guys are going to see your electricity bills go up. But for some strange reason, the people on the news will always tell you, we've got our CPI is very low, it's 1% per annum. No, well, I totally disagree. Our electricity bills are going up by about 6-7% per annum. Where has it gone? I'm trying to find it. Someone help me find that one too.
Wow, that sounds like an interesting little mystery you're onto there, Brian. I look forward to reading that, and I'm sure I'll speak to you soon.
Okay, thanks, Lockie, and thanks to everyone.
Well, that was a great chat I had with Brian Chu just then. He noted a couple really interesting things about how the CPI is calculated, as well as the seasonality in the gold price. Now, if you want to learn more about what Brian Chu does, you can find links to that in the description below. That's Rockstock Insider and Hard Money Trader. I'd also really encourage you to get in touch with me. If you have any questions or would like me to focus on a particular topic, I'd really appreciate hearing from you. Be sure to subscribe and you'll hear from me soon.